Ah, the stock market. A magical land where fortunes are made and lost, sometimes in the blink of an eye. It's a place where companies big and small, from tech giants to your local pizza joint, can raise money by selling pieces of themselves. These pieces are called stocks, and owning them means you own a tiny part of the company. It's like owning a single pepperoni on a giant pizza. You get a taste of the action, but you don't control the toppings. Now you might be thinking, John, why would I want to own a tiny slice of a company? Well, my friend, that's where the potential for profit comes in. If the company does well, the value of your stock goes up, and you can sell it for more than you paid. Imagine buying a pepperoni for $1 and then selling it for $5. Not bad, right? But here's the catch. If the company tanks, so does your stock. You could end up with a soggy, worthless pepperoni that nobody wants. That's the thrill and the terror of the stock market. It's a high-stakes game where knowledge, strategy, and a little bit of luck can make all the difference. But don't worry, we're going to break down this complex world into bite-sized pieces so you can navigate the market with confidence. And who knows, maybe you'll even make a few bucks along the way. Let's talk about equity, shall we? In the simplest terms, equity is ownership. When you buy a stock, you're buying a small ownership stake in a company. You become a shareholder, a part owner of that pizza joint, that tech giant, or that company that makes those weird socks with toes. Owning equity can be exciting. It's like being a tiny ant on a giant anthill, carrying your weight and contributing to the success of the colony. If the company thrives, your little ant-sized investment could grow into something substantial. You could be sipping lemonades on a beach, all thanks to your wise equity investments. But remember, owning equity comes with risks. Just like that anthill can be disrupted by a rogue foot or a sudden downpour, your company's fortunes can change quickly. Market crashes, bad management decisions, or even a global pandemic can send stock prices plummeting. Your lemonade dreams could evaporate faster than you can say stock market crash. So, how do you choose the right companies to invest in? Well, that's where things get tricky. You need to research companies, understand their business models, and assess their potential for growth. It's like choosing the right pizza toppings. You want a combination that's delicious, satisfying, and won't give you indigestion later. Let's face it, not everyone enjoys spending their evenings poring over financial statements and analyzing market trends. Some people would rather watch paint dry or listen to Nickelback on repeat. If that sounds like you, then mutual funds might be your jam. Mutual funds are like pre-made pizzas. Instead of picking individual toppings, stocks, you buy a whole pizza with a predetermined mix of ingredients. A fund manager, like a skilled pizza chef, selects a basket of stocks based on a specific investment strategy. They handle all the slicing, dicing, and baking while you sit back and relax. The beauty of mutual funds is diversification. By investing in a variety of stocks across different sectors, you spread your risk. It's like having a pizza with pepperoni, mushrooms, onions, and peppers. If one topping doesn't agree with you, the others can still satisfy your hunger. Of course, mutual funds have their downsides. You're trusting someone else to manage your money, and their investment decisions might not always align with your goals. Plus, you'll have to pay fees for their services, which can eat into your returns. It's like paying extra for delivery. Convenient, but it adds to the cost. Section 4. SIP. Slowly drizzling money into the pie. Now, imagine you want to buy a pizza, but you're on a tight budget. You can't afford the whole pie right now, so what do? You start saving. You put aside a small amount of money each month until you have enough to buy that delicious, cheesy goodness. That's the basic idea behind a systematic investment plan, or SIP. Instead of investing a large sum of money all at once, you invest a fixed amount at regular intervals, like monthly or quarterly. It's like slowly drizzling olive oil on your pizza dough. A little bit at a time adds up to a flavorful crust. SIPs are a great way to invest for beginners. They encourage disciplined saving and help you ride out market fluctuations. By investing consistently, you buy more stocks when prices are low and fewer stocks when prices are high. It's like getting a discount on your pizza when demand is low. However, SIPs aren't a magic bullet. They don't guarantee profits, and you still need to choose your investments wisely. It's like adding the wrong toppings to your pizza. Even if you drizzle olive oil consistently, it won't make up for a bad combination of ingredients. And just like pairing your pizza with a refreshing glass of lemonade, choosing the right investments can make your SIP experience much more enjoyable. Section 5. Weighing the good and the bad. Is pie worth it? So, we've explored the ins and outs of equity, mutual funds, and SIPs. We've talked about the potential for profits and the risks involved. Now, the million-dollar question: is investing in the stock market worth it? The answer, my friend, is not so simple. It depends on your financial goals, your risk tolerance, and your investment horizon. Are you saving for retirement? Do you want to buy a house? Are you hoping to strike it rich quickly? Your investment strategy should align with your goals. Investing in the stock market can be a great way to grow your wealth over the long term, but it's not a get-rich-quick scheme. It requires patience, discipline, and a willingness to weather market storms. It's like baking a pizza. It takes time, effort, and the right ingredients to create something delicious. Before you jump into the stock market, do your homework. Research different investment options, understand the risks involved, and consider seeking advice from a financial advisor. It's like asking a pizza chef for recommendations. They can guide you towards the best options based on your preferences. Section 6. The financial roller coaster. Hold on tight. The world of finance is a wild ride, full of ups and downs, twists and turns. It's like a roller coaster that never stops, with moments of exhilaration and moments of sheer terror. But with the right knowledge and a bit of courage, you can navigate this roller coaster and maybe even enjoy the ride. Remember, investing is a marathon, not a sprint. It's about making informed decisions, staying disciplined, and riding out market fluctuations. And who knows? Maybe one day you'll be sipping lemonades on a beach, all thanks to your savvy investment choices. But until then, buckle up, my friend. The financial roller coaster is about to take off.